Okay, so here we are. We are about to begin. Ji Harar Walaikum Assalam. Our unit 4. We are just in between, in the middle of your financial reporting. So we are starting unit 4 tonight. These are the topics that we will be covering, different types of expenses and liabilities. This is for tonight. We will do leases. This is the new leasing standard. And then we'll be doing income taxes and accounting for bonds and non-current notes payable. This technically is not a part of your syllabus since 2015 January. I do not know why this topic is hanging around in Glein's book. It is there in the software, so there's no harm in doing it. We will do it. So we will do it despite it's not in the syllabus. At least it will give you a sense of completion that we have done everything. So let's start for the topic for tonight, different types of expenses and liabilities. All right. Ji Yusuf Walaikum Assalam. The first expense we are going to discuss is the loss related to a purchase commitment. Let's say I have agreed to purchase a certain quantity, let's say 2,000 pounds. Let's use the same numbers that we have in the example. Let's say I have agreed to purchase 2,000 pounds of an item at a price of $64 per pound. This is the contract with Yusuf. This is the agreed quantity. This is the agreed price. Now I am bound to purchase this quantity at this price. Right? What happens if the item's price falls, maybe to 52, that's what is given in the example? I am still bound to pay $64. Why? Because this is the purchase commitment. I will have to honor the commitment. I will have to pay $64 per pound, even the market price is 52. So this extra amount I'm paying, which will be probably 12 per pound times 2,000, $24,000. This is the loss that I must book in my accounting records. I must disclose this separately. So this is called the purchase commitment. Let's overview the theory and then go to an example that will explain the idea. Purchase commitment, as the name suggests, is the commitment that I will purchase a certain quantity at a certain price. It is not recorded. When I made the commitment with Yusuf, I did not make any entry because there is nothing. No goods have been delivered yet. So there is no entry. But if the price falls, I must record a loss. Even there is nothing. Just the price has fallen. I have received nothing. Yusuf has given nothing. But since the price has fallen from $64 to $52, I must record this as a loss for the period, right? So if the current market price of the good is less than the commitment price is 64, the market price is 52, I must book this as a loss. Ji Subhan Walaikum Assalam wa rahmatullah. So I must book this as a loss for the period, right? So if such a contract is entered into, no entry is made at the date of contract, but if the price falls, at the balance sheet date, the price is lower, you have to record this as a loss. You have to show it as a loss, show it separately in the income statement. Zahid Walaikum Assalam. Yes, this is the first slide, Subhan. Very first slide. See, we just discussed that we are doing these 4 topics and we have just started doing this. So let's go straight to the example and that will explain the idea, how we go about, and then we can rediscover the theory. So if there is a loss, like in this example, I agreed to purchase an item for $64 per pound. The price falls to $52. There is a loss, no doubt. I need to bring this record in my accounting records, and I must disclose this loss in my financial statement also. The nature and the term of the contract, it was a non-cancelable contract with Yusuf. And if there's a loss, I need to describe the nature of the loss, the term of the contract in my financial statements. And I must show it as a loss as a separate line item in my income statement. So let us see the numbers. During the year, Lisbon Company signed a non-cancelable contract to purchase 2,000 pounds of raw materials at $64 per pound during the forthcoming year. This is the price at which I have agreed to purchase. This is the quantity. No entry, nothing has happened, just a contract, non-cancelable contract. What happened on 31st of December, the market price of the raw material is $52 per pound, which means the price I agreed to pay is higher. The price on the balance sheet date is lower. And accordingly, since now the price is lower, I may have to change my selling price as well because the input cost has changed. Now what I'm going to do, there is a $12 loss per pound and there's a total loss of $24,000. There is no entry related to this purchase. No entry at all. Because when a contract is entered, no entry is made. But since now there is a loss, your US GAAP requires the recognition of a loss in your income statement on this purchase contract, even there is no physical transfer of goods. So what is the entry you're going to make? This will look little unusual, but please try to make sure you understand it. There is a loss, and that loss is still unrealized because no involvement of cash, not actually transfer of any asset has taken place. So you're going to debit the unrealized loss. And what you're going to credit, you didn't pay anything. You will credit the purchase commitment liability with $24,000. So this is the entry you will pass when there is a reduction in the price compared to the price you agreed to versus the price on the balance sheet. Now, what will happen when you will actually receive the goods? You will actually receive the goods. Let me just complete the entries, gentlemen. Yes, it's a short-term liability. It will be reversed as soon as the goods are received and the payment is made. So remember, I have booked the loss before actually receiving any goods. This is the entry for the loss. Debit loss, credit the purchase commitment. Now I'm going to receive the goods physically, right? When I physically receive the goods, remember the price that I'm going to use is $52 multiplied by 2,000. Now I'm going to book $104,000 as my inventory, and I'm going to credit the payable with 104. Now, but remember, I have to pay not 104, I have to pay 2,000 multiplied by 64, which is basically 128, right? I have to pay 128. So remember, this is the payable under this entry, and this is the payable, the recognition of the loss. So 24 plus 104 gives you the total liability of 128. And when you settle this liability, you debit the payable with 104 plus the previous 24. You debit it with 128 and you credit it with cash. So despite the inventory purchase had a value 104, the extra amount you're paying basically is the loss that you must report on your income statement as a line item. Now, read this example. A corporation entered into a purchase commitment to buy inventory. At the end of accounting period, the current value of the inventory was less than the fixed purchase price by a material amount. Like in our example, it was $12 per pound. Which of the following accounting treatment is most appropriate? We have just discussed that. Describe the nature of the contract in the notes to financial statement. Yes. Recognize a loss in the income statement immediately on the balance sheet date when the price has fallen, and recognize a liability for the accrued loss. Since it has not yet been paid, you will debit the loss, unrealized, and you will credit the liability, right? So this is a perfect statement. Why not BCD? You should have good reason for rejection. Describe the nature of the contract, correct, and estimate the amount of loss. You don't need to estimate. The numbers are there. The numbers are there. But do not recognize the loss in the income statement wrong. We have to recognize it as a loss. Then describe the nature of the contract in the notes to financial statements. True. Recognize a loss in the income statement. True. Recognize a reduction in inventory equal to the amount of loss by use of valuation account. Valuation account normally is used when we create a deferred tax asset or a deferred tax liability. So this is something not related to the inventory. Valuation allowance is created in order to show the deferred tax asset in the most appropriate form, in the most appropriate amount. So we'll discuss. This is totally irrelevant here. Neither describe the purchase obligation nor recognize a loss wrong. We will have to recognize a loss if the price falls. Net losses on the purchase commitments to acquire goods for inventory results from a contract price that is $62 from the current market price that is $54. That's what we just discussed a little while ago. If the firm expects that losses will occur when the purchase occurs, expected losses should be treated how? We've just discussed this. Should be recognized in the accounts, separately disclosed as losses in the income statement, disclose them separately, of the period during which the decline in price takes place. That's exactly what we have just done. If there is reduction in price, you must bring this in your accounting records as a loss for the period and show it separately. Now, next type of expense, what we are doing, different types of expenses and liabilities. So our next topic within this subunit is warranty liability. Now, let's first discuss, if there is a gain, in that case, you're going to debit. Let me first bring it to you. Now you have agreed to purchase an item for $64, right? If the market price goes to $70, this is what you're going to pay for the inventory. So you will debit. This is basically the cost to you. Even you have agreed to purchase at 64, but this is the amount at which the inventory is available. So you will debit your inventory with 70. You will credit your liability with 64. The surplus 6 will be gain. Right, so inventory will still be reported for what you are paying. What is the current market price? 70. So this extra $6 will be treated as a gain in this contract. Next is the warranty liability. What is warranty? Warranty is a written guarantee. Written guarantee for what? Written guarantee that the product I'm selling, if it develops a fault, I will repair, or as a seller, I will replace, or I will refund some part of the price, or maybe I will provide you some additional service. So when I sell some product, I also give a written guarantee that if there is any problem with the product, I will do the repairing, replacement, refunds, or any additional service. So remember this written guarantee, this assurance regarding the product's utility or its usefulness, it is for specific time. It is not forever. It is for a limited time, 2 years, 10 years, and it is not forever. Now, the important point here to remember is there are two types of warranties. One is the what you call the expense warranty, or also called the assurance type warranty. Let me write this down. Two types of warranty we'll discuss. The first one is the assurance type warranty. Assurance type warranty. Hamad, please rephrase your question. Kind of guaranteed revenue related to warranty. Now, assurance type of warranty, sometimes it is also called the expense warranty. Sometimes it's called express warranty. Please write down these names. You might mix things up. Assurance type warranty, express warranty, or sometimes it's called inseparable warranty. Mind the word inseparable warranty. Why? Because this is not sold separately. It is sold as a part of the product. So the first type of warranty we're going to discuss, and almost 100% questions on warranty relate to this first type of warranty. Because when you buy a product, warranty comes with it. You do not pay separately for the warranty. Warranty comes with the purchase price. There is no separate payment. There is no separate payment. Warranty is a written guarantee. In a way, they are similar, but when it is expressly given in a contractual form, then it is called warranty. A written guarantee is what you call warranty. Otherwise, guarantee may be implied, it may be unwritten, but when it is contractually given to the buyer, then it's called warranty. A written guarantee is called warranty. Now remember, the first type of warranty is called assurance type warranty, expense warranty, and sometimes it is called the inseparable warranty because it is sold with the product. When you buy a product, it comes with it. Right? Inseparable warranty, expense warranty, or assurance type. Now the important point is, let's say maybe the warranty period is 5 years. And as per your past records, 2% of the warranty might be incurred in the first year, 3% in the second year, and 5% in the third year. So what do you think? You're going to charge 2% warranty expense in the first year, second year, third year? No. Matching concept says that if you sold item in year one, the entire warranty expense must be booked now in year one. Because since the sale is in year one, all the warranty expense, the likely warranty expense in the coming years must be recorded as an expense right now. So this is what you call the assurance type of warranty, and this is 100% of your questions are on this type of warranty. There's another type of warranty we'll discuss later. Let us first do it. So as I just told you that this type of warranty is sold as a part of product. So as soon as the second one we'll discuss later, as soon as you sell the product, the warranty expense is recognized immediately so as to follow the matching concept, because on the day the product is sold, we will immediately book a certain amount of estimated warranty expense, right? Even the warranty period is extended up to 10 years, the entire amount of warranty expense must be recorded as a liability and expense in the same year in which you sold the product, right? So as I told you, expense warranty, assurance type warranty, or the inseparable warranty. Now, how does it work? What is the accounting entry, or I would say, what is the account format that we'll be using in order to solve question related to this type of warranty? So I'm going to draw a format just like the format we had for allowance for uncollectible accounts or for sales ledger control account. This format will be very handy for you. So you will create a warranty liability account. It will have some balance brought down. Any warranty expense that you recognize during the current period, you make this entry, you debit the warranty expense, and you will credit the warranty liability. Let's say an item that you sold for $800,000, there are 3% given, 2%, 3%, and 5%. This is the estimated warranty expense in year 1, 2, and 3. You add this up and you charge the complete 10% in the first year in which you sold the item. So you're going to debit warranty expense with 80,000 and you credit the warranty liability with 80,000. So this is what you will write as warranty expense. Please remember, it is the estimated warranty. It is the estimate of warranty. When you actually pay the warranty cost, or maybe you pay cash or you use some parts or labor, in that case, the debit is given to warranty liability and credit is given to cash if you are refunding. Credits are given to your repair work, maybe some parts are given, whatever is being given, cash or parts or a new product, whatever. So warranty liability will be debited and something will be credited. Just let's write it, the actual warranty expense. This is the warranty expense estimated. This was an estimate. But when the actual payments are made for warranty, then you are going to credit it with the actual expense. Please mind the word actual warranty expense. This is the estimated warranty expense, right? It is possible that I had an opening balance of warranty liability 5,000. During the year, I created 80,000 warranty expense estimate, which means I have $85,000 in warranty liability. Let's say during the current period, my warranty expense paid was $115,000. Subhan, $115,000. In that case, the excess amount, which my warranty liability doesn't have, the excess amount, in this case, it's 85, 95, 20,000. Or is it 30,000? Whatever the surplus is, the difference between 85 and 115, the extra amount goes to profit and loss account. It is charged to the income statement. Remember, if your actual expense is more than 35, if it is 35, I am so much dependent on calculator. Even it's a very simple subtraction, 115 less 80. That's the drawback of working too much on calculator. So gentlemen, the extra 35,000 will be charged to the profit and loss account as shown here. I told you actual payments, when you make, they are deducted from warranty liability. If your warranty payments for the period are greater than the amount of warranty liability, Subhan, to answer your question, the excess is recognized in the warranty expense in the income statement. Now I have given you the format. Let us try to apply this format in a good question that comes in the next slide. Now, gentlemen, please be with me. Year 1, a company began selling a product under a 2-year warranty. The estimated warranty costs are 3% of sales in the first year and 5% in the second year, which means the total warranty expense will be 8% of the selling price. Sales and actual warranty payments for the year 1 and year 2 are as follows. In year 1, we sold goods worth $300,000. The actual warranty payments were $5,000. In year 2, the sale was $500,000. The warranty expense was $37,000. Right? What you're going to do, forget about the solution. We will do it our way. We just discussed that warranty liability will have an opening balance. It will have the actual the warranty expense estimated and the warranty expense actual. Please remember, it is the estimate, it is the actual. Now, there is no balance because the company just began selling. There is no opening balance of warranty liability. This is the first sale ever, and 3% in the year of sale, year 1, and 5% in year 2. We will charge the entire 8% now. 300,000 times 8%, that is 24,000. So we are going to debit the warranty expense and credit warranty liability, which you can see. The actual payment for warranty in year 1 was 5,000. What's going to be the entry? Debit the warranty liability, credit whatever you are giving, parts or cash or whatever. So warranty liability will be debited with the actual payment. Now, what's the balance now? 24,000 estimate, actual expense 5,000. Now you have the remaining balance 19,000. This balance will be carried forward or carried down to the next period. Now the brought down is 19,000. What happened in the next year? The next year sale was $500,000, of which 3% is in the same year and 5% in year 3. We will charge the complete 8% in the year of sale. That is the matching concept. 500,000 times 8%, so it's going to be 40,000. So you will debit the warranty expense account, credit the warranty liability with $40,000. This is the estimate. The actual warranty payments were 37,000. So 40 plus 19, 59. 59 less 37 gives you 22,000. So the closing balance, this is the actual warranty. The closing balance is $22,000 carried on, and that's the exact number. So it is entirely up to you. If you want to follow this statement format, be my guest. Do whatever you want to do. But I recommend, being a conventional old-fashioned accountant, I would prefer the T form. Here you can find the unknowns quite easily by just balancing the accounts and find the unknown that you want to. So this is how we do it. Write the opening balance, any warranty expense estimate, the actual warranty expense on the debit, the difference, the closing balance will then appear as an opening balance in the next year. So all your questions are related to assurance type warranty. There is another type of warranty called the separable warranty, or sometimes called the service type warranty. Now, what is the difference between these? And this is pretty unusual. I'm sure you wouldn't have seen any such warranty in your professional career. Separable warranty, as the name suggests, it is sold separately from the product. Right? Let's say if I'm the seller, I've sold an item and revenue for this is recognized separately. I sell a product separately. Question. Yes, my friend Hamad, this is called matching concept. Since you have recognized the entire sale in year 1, why should I carry the warranty expense in year 2, 3, 4? No, this is called matching concept, my friend. You have to write it down in the same period. Let me show it right here. See. Look at this. Liability of warranty cost is recognized when the related revenue is recognized on the day the product is sold. This is called the matching principle, the entire amount, right? The whole of it, Hamad, is recognized in the same period when you sell the item. Please keep that in mind. So we were discussing that this type of warranty, it is sold separately. It is sold separately from the product. And let's say if I've received, let's say I received $15,000 for an item's warranty. This is the service type warranty, also called the separable warranty. I sold it separately. I will receive cash, but this 15,000 I have not earned. Why? Because the item covers a period of 3 years. And this warranty amount I've received, separable warranty, this is sold separately from the main product. I have given 3 years to the buyer, which means that this $15,000 which I received is not my income now. It will be released to income, but over a period of 3 years. So I'm going to split this 15,000 on 3 years basis, which means every year I'm going to consider 5,000 as my income. So what you will do, you will write it as deferred income because you have not yet earned it. You have received it, but you have not earned it. So what you will do at the end of every year, you will transfer 5,000 from deferred income to income by passing this entry. You will debit deferred income 5,000 and you will credit the income account or the earned income 5,000. You will keep on doing it for your 1, 2, and 3 by the time your full deferred income is released to your income statement. This is very rare, and that's the reason you don't have a single question on the Gleim software that discusses this separable warranty. So let us go straight to the kind of questions you should expect. This is the one. Hamad, especially for you, just focus. An entity sells appliances that include 3 years assurance type warranty. Service calls under the warranty are performed by an independent mechanic under the contract with the entity. Based on the experience, warranty costs are estimated to be 30 for each machine sold. Despite a 3-year period is covered under this assurance type warranty, it says when should the entity recognize the warranty cost? Debit warranty expense, credit warranty liability in the year of sale. Absolutely, Fahad Talha, you're absolutely right. When the machine is sold, when the sale takes place, at that point, you should recognize the entire warranty liability. That makes D to be the correct option. A company manufactures stereo systems that carry 2-year assurance type warranty, expense warranty, or the warranty that is not separable. Against any defects, based on past experience, warranty costs are estimated to be 4% of the sale of the warranty period. During the year, stereo system sales total 3 million. So they have given you a total single percentage rather than splitting it up into number of years, 4% of the sales value over the period of the warranty. So it says that during the period you have sold goods worth $3 million and warranty cost actual was $67,500. This was the actual cost. In its income statement for the year ended December 31st, the company should report warranty expense. Please be very, very, very careful what you're doing while attempting the question. Warranty expense, not the warranty liability. Now, let's just play with the question to understand, to get a deeper understanding. When we sell goods worth $3 million, we will immediately charge warranty expense at the rate of 4%, which is going to be 120. Absolutely right. You will debit the warranty expense that goes to the income statement and you credit the warranty liability, 120. Right? So this is your warranty liability. And now it has got 120,000 on the credit, right? Actual warranty cost incurred was 67,500. When we actually incurred a warranty expense, we got the answer. This is the right answer. We are just playing with the question. So this 67,500 is the actual warranty cost. This appears on the debit side. Now, if you find the balancing figure, 120 less 67,500 gives you 52,500. So if the question asked or required, what is the balance in warranty liability, Fahad Bhai? 52,500, right? And when the question says, what is the warranty expense charged to the income statement? You're talking about 120. So he has given you both of these options. So be very careful what you're doing, what the requirement of the question is. I always recommend students that when the question is a little fuller, so you should highlight the specific requirement of the question, because your exam simulation at Prometic has this facility that you can highlight a certain text that you want to be mindful of. This 52,500, it is shown as a part of current liabilities on your balance sheet. So that gives you D to be the correct option, and D it is. Next. This is again a fuller question, Fahad, similar to the one we have just done. During year 3, a new product carrying 2 years assurance type warranty against defect was introduced. The estimated warranty cost related to dollar sale was 2% within 12 months and 4% in the second 12 months. Sales and actual warranty expenditures for the year are given below. This is the sales. This is the actual warranty expense paid, sales paid, and for the years 3 and 4. Now, what is the requirement? What amount of estimated warranty liability? Now, this question explicitly requires you to calculate the balance of warranty liability. Balance of your warranty liability. What you're going to do, open warranty liability account. First year 3 sale is $600,000, and 6% of this amount is going to be the first expense we should charge. Debit warranty expense account, and credit warranty liability account. This is your warranty expense. What was the actual warranty payment? 9,000. This is the actual warranty expense, just for short. So the balance you have is 36 less 9, it's 27. Balance is 27. This will be carried down next year and it will appear as a brought down next year. Now what happens next year? The sale next year was 1 million. 1 million's 6% will give you $60,000. 1 million times 6% will give you $60,000. And the actual warranty expense that year was 30. Actual warranty expense. So the balancing figure would be 27 plus 60 less 30. It gives you 57. So the closing balance in your warranty liability is 57. That gives you C as your correct option. And C it is. Next. On April 1st, a corporation began offering a new product for sale under a standard 1-year assurance type warranty. Of the 5,000 units in inventory at April 1st, 3,000 had been sold by June 30th. Out of 5, these are the units sold. Based on its experience with similar products, the corporation estimated that the average warranty cost per unit sold would be $8. So rather than giving in percentages, given just lump sum, a single figure of $8 per unit sold. Actual warranty costs incurred from April 1st through June 30th were 7,000. At June 30th, what amount should the corporation report as an estimated warranty liability? Warranty liability will have nil opening balance. Why? Because the corporation began offering a new product, which means there is nothing in the beginning. Since 3,000 units are sold with $8 estimated warranty liability, that means the total warranty expense will be 24,000, 3,000 times 8. So the entry will be warranty expense debit goes to income statement and warranty liability credit with 24,000. Warranty expense. The actual warranty expense is $7,000. Now it's fairly straightforward now. 24 less 7, and I will have to use my calculator. Very bad at mental maths. 17. Brought down, the carried down value is $17,000. So that makes C to be the correct option. Correct. All right, next. Now we have next topic here. Contingencies, recognition, and reporting. First of all, before we start this topic, you will have to create a story to understand it well. All right, now look at this gentleman who appears to be injured, badly injured. Yes, he is. He is an employee, Salman, in your firm. Let's learn. You are the one. Let's bring you in the picture. Salman Incorporated. This guy is an employee in Salman Incorporated, right? He got injured, seriously injured, and now he has filed a suit against you, Salman, in the court of law, requiring $3 million compensation for the injury caused. He believes that he was injured because he was not provided the protective gear. The company's safety standards were poor, and this injury is entirely because of the loose safety standards at Salman Incorporated. Now, this $3 million amount claimed, this claim is pending in the court of law. Now, there are two parties, Salman Incorporated, and let's say take it as Amir, the person who got injured, right? Salman, if the court decides against you, you may have to pay $3 million. It's going to be your loss. And if this gentleman on the other side wins, it's going to be his gain. So for Salman, for you, it's a loss in case you may have to pay. And for this gentleman who got injured, for him, it's gain. Since none of you are sure, neither you, Salman, nor this person, Amir, what is going to happen, that's why it's called contingency. The outcome of this $3 million is dependent upon the court's order. Now, for Salman, it's going to be a loss. For Amir, it's going to be a gain. And both of you are unsure what is likely the future situation. Now, so let's now define what we are doing. what is a gain contingency and what's a loss contingency. A contingency is an existing condition where Amir has filed a case in the court of law against Salman Incorporated, a set of circumstances involving uncertainty. The decision can be in favor of Amir or it can be in favor of Salman. So it could be a possible gain for Amir. In this case, it's called the gain contingency, or a loss contingency to Salman Incorporated. Now, will it be a gain or a loss? In reality, after some time, it is dependent. It is ultimately resolved through some future events where the court decides in one party's favor, whether Salman Incorporated or Amir Incorporated. So let us first see. So you got the idea. A case is in the court of law. If it goes against Salman, it's going to be a loss for him. So he's not sure what is going to happen. So it's a contingent loss. So you can say that this is a loss contingency for Salman and a gain contingency for Amir, and it is dependent upon the outcome of the future when the court decides on the case. Now, contingencies can take three forms. Now, you have to be very careful what I'm going to tell you now. If contingency is probable, please look for this lovely word probable, just this word, not percentage, 70 or 80%, just look for this word probable. If you find this word in the question, paise thuk gaye. Future events are likely to occur, which means Amir will get $3 million compensation and I lose $3 million. Salman, you lose this $3 million because it is likely to occur. The decision will be against you in the court of law. If it is probable, if the event is probable, in that case, Salman, you are going to book it as your loss. Even you haven't paid anything, but you are going to, yes, you are going to recognize it as a loss, even it hasn't happened. Our prudence concept says that if the loss is likely and it is probable, then don't wait for the loss, book it now. That's the prudence concept. So you need to book this loss now, even if you haven't paid anything. This gentleman, he cannot recognize it as a gain unless he actually receives the fulus. He actually receives cash. So if the event is probable, Salman, you're going to book it as a loss. You debit loss, $3 million, and credit the liability against this loss because you haven't paid it yet. So you will debit the loss, charge to income statement, and you credit the liability because you haven't settled. So if it is probable, Salman, for you, it's a loss. For this gentleman, nothing. He will maybe disclose it in his books of accounts, but he cannot recognize it as an income unless he actually receives cash. The second case, it is reasonably possible. Look for these words, reasonably possible, which means the chance of occurrence is less than probable, but it is more than remote. What is remote? Let us see it right now. Remote means the chance of occurrence is slight. So if the probability is between probable and remote, then it must be in a house that is reasonably possible. In this case, Salman, what you should do, you should not recognize it as a loss. You should disclose it in the notes only. No recognition of loss. And for this gentleman, still, he cannot consider it as an income unless he actually receives cash. And in the third case, when the chances are remote, this guy will lose the case in the court of law. And Salman, you don't have to be worried. When the chances are remote, neither he makes any entry or he discloses, nor Salman, you need to disclose anything. So please, I'm going to have a quick look at it. Probable means event is most likely to occur. Salman, for you, it's a loss. For him, he may disclose in notes, but no income for him. In second case, when the event is reasonably possible, you will disclose in the notes, he will do nothing. If the event is remote, no chance of occurring or very little chance, none of you will do anything. No disclosure, no entry. Right now, let us see these in more details. I told you loss contingency must be accrued when these two conditions are met. Number one, it is probable. It is probable. Look for this word probable. This will hint you that what you should do with the information given. Probable. That more likely to occur. It is likely to occur. And the second is amount can be reasonably estimated, which was $3 million. Now, what if the amount is not specifically mentioned, a range is given. Let's say the range that we may have to pay, Salman, you may have to pay, it is between 2.5 million to $3 million. So if the amount is not exactly known, a range is known, then you should take the lower value, right? That's what it says here. When a range is available, then you should take the minimum one. Between 2.5 to 3 million, you should take 2.5. So Salman, if the loss contingencies is probable and you can estimate the amount, either exact amount or a range, go for the low range. You will not only book it as a loss in your income statement, you must also disclose in the detailed notes what happened. Amir got injured. Amir has filed a case against us in the court of law, and the compensation might be somewhere between 2.5 to 3 million, so that the users of financial statement, they will know what is going on. When the case is not probable and the amount is known, Talha, you will only disclose in the notes. That is coming in the next slide here. When one of the conditions is not met, it is not probable, but you know the amount, then in that case, you just disclose it in the notes to the financial statement. You should not recognize it. You should only recognize when it is probable. That's the word I'm emphasizing. You should look for the word probable. When it is reasonably possible, no entry, just you need to disclose it in the books of accounts. And in case, if it's the loss contingency, remember, and if it is remote, do nothing. In case of remote, do nothing. Yes, exactly, Subhan, got it. If it's remote, you don't have to disclose, right? Now, if you look at from the side of the injured party, Amir, for him, he will disclose it in the notes, but he cannot recognize it as an income unless he actually receives cash, right? Unless, because let's say if Amir wins the case in the first court, civil court maybe, then the court will go to the high court. I can appeal against the decision in high court. Even Amir wins in high court, we can still I can still file an appeal in the Supreme Court. So that is the point to be noted here. That's the point. An award of damages in the lawsuit is not, unless it is realized, you cannot consider it as an income. In both cases, probable and reasonably possible. Let me take you back, Talha. Probable, he will disclose in notes only. Reasonably possible, he will disclose in notes only. Right? And in this case, no disclosure is required. And in the case of loss contingency, probable is booked as a liability as well as disclosed. And for reasonably possible, you need to disclose. Right? Now, I told you that the gain contingency can only be recognized in the books when the amount or cash has been received. So let us try to solidify what we have just learned in the questions. Okay. A liability arising from a loss contingency, what should we do with it? We have just discussed amount is reasonably estimated. That is one part of it, not the second, because we will consider loss contingency only when two conditions are met. Number one, the probability. Mind the word probability. It is probable that this will occur, and plus the amount can be reasonably estimated. Absolutely, Fahad, Talha, you are absolutely right. Contingent event will most probably occur, and amount of the loss can be reasonably estimated. These two conditions must exist simultaneously for us to recognize it as a loss liability. So that makes D to be the correct option. Next. Which of the following loss contingencies would be accrued as a liability rather than disclosed in the notes to financial statements? A guarantee of the indebtedness to another. Let's say, Hamad, you took a loan and you asked for my guarantee for the loan. So this is not my liability unless Hamad defaults. It is not my liability. If Hamad defaults, then I become liable. So this is not right here. But just being a guarantor doesn't mean you are liable unless the default takes place. So this is wrong. A dispute over additional income taxes assessed for prior years, now in litigation. Since it is in litigation, so we are not sure the outcome of what's going to be the outcome of this litigation. A pending lawsuit with uncertain outcome, khalas. When it is uncertain, it is not even possible. Ignore that. Liability for service or product warranties made as a regular part of the business. Yes, warranty is a liability. It's a contingent liability that the customer might come with the default, with the faulty goods. Next. Linden Corporation is a defendant. Let me tell you, there are two parties. Just in the previous case, Amir, who filed a case against Salman, he is Plaintiff, mind the word plaintiff, the party that files the case in the court of law. And defendant is the party that defends itself against a case. Like Salman Incorporated, in our example, was defendant and Amir was the plaintiff. Now, Linden Corporation is a defendant in the lawsuit where the plaintiff is seeking 1 million in damages for what? The company had terminated the plaintiff, George Russell, who is the plaintiff who filed case against us. He was fired. Why? Because from his position with the Linden after Russell allegedly sold specification for one of the Linden's new products to the competitor. Russell is alleged to have sold our trade secrets, so he was dismissed. So Russell went to the court of law and he filed a case against Linden Corporation. Linden attorney believes that it is quite possible, not probable. Possible, gentlemen, possible. I asked you to look for the word probable. It is possible Linden will lose the case. If so, damages could range between this and this. Regardless of the outcome of the case, Linden's accountant estimate the company will incur an additional 5,000 in unemployment costs of Russell's termination. The amount the Linden should accrue because of the contingency in this situation. Since it is possible, not probable, so we are not going to book any liability. This is not a part of contingency. This is the regular expense you pay like salary, wages, etc. So this will not appear here. 5,000 is related to your normal employment related cost. It is not a part of contingency cost, right? So we are not going to book any contingent loss because the event is possible. Yes, however, we might disclose it in the notes to financial statements, right? So that makes a D to be the correct option. Okay, next. A company is plaintiff in two lawsuits. So this is a wonderful question. We will spend some time on this question. A company is plaintiff in two lawsuits. There are two lawsuits, lawsuit A, lawsuit B, and you are plaintiff, means you have filed a case against someone in the court of law for some damages. The first suit involves a competitor who has made an exact copy of one of the company's products, and the company is suing for the patent infringement. So one of your competitor copied what you do, what is your product, and you have filed a case against that party for copyright infringement. Now, in the first case, the attorney estimates a 5 million award. This is the estimate. It's a gain contingency, by the way, because you are the plaintiff. For you, it's a gain. So 5 million award for the company. However, it is anticipated that the case will be in litigation for 2 to 3 years before a final resolution. So the amount is given, but it is neither possible nor probable, and it is going to extend from 2 to 3 years in litigation process. So we have just discussed a gain is not recorded unless it is actually received. So we are not going to record any gain contingency. It may be disclosed in notes, but not any gain in contingency. The second case also involves patent infringement. However, in this instance, the attorney do not believe the company has a strong case. Remote. It is estimated that the company has a 50% chance of winning an award, and if any, it would be somewhere between 250 to 1 million. The most appropriate amount to be recorded as a gain contingency, maafi, nil. Gain contingency cannot be recorded in the books unless you actually receive fulus, actual cash or actual money is received. So in this case, you're going to report it as nothing. You're going to report nothing. So that completes your different types of expenses and liabilities. Tomorrow you have a very, very important lecture relating to leases. This is the new leasing standard, which might have affected some of your works you're doing, because this leasing standard has been revised both at IFRS level as well as US GAAP. There are some minor differences, yes, but you need to do it in detail. So we will be spending entire lecture tomorrow on leases, and that is all for today.